Hello class, welcome back. In this video, as well as the next video, we're going to talk about step 3 in applying revenue recognition. And step 3 is to identify the transaction price. A recap of what we have just learned in the previous video. We talked about what the contract is in step 1. And we also talked about what performance obligations are. Basically, you can think of it as promises. How many promises have you made in one contract to your customer? We can separate into two situations. One is when we have only one single performance obligations. Well, then everything seems pretty easy. And when we have multiple obligations, we have to allocate a price, right? This is gonna be covered in step 4. And then we will also talk about, when are we gonna recognize each different performance obligation. But on this video, we will focus on step 3. That is to determine transaction price. So regardless of whether you have only one performance obligation or multiple performance obligation, you still have to do this part. So step 3 is sort of independent when we talk about the requirement from step 2. Now, it is pretty straightforward and simple if the buyer pays a fixed amount immediately or in the near future. So we don't have to determine anything, it's fixed, that's it. We're gonna take it as given. But it is getting more complicated to determine the transaction price when we have variable in the situation, which means the price, the revenue will change according to different situations. And it's also getting complicated when we have the situation of time value of money. Now, in this video, in this chapter, I'm not gonna talk about time value of money because number 1 is simple, and number 2, we will talk about it in when we talk about long-term bond. But basically, that means under this situation, it means if you're gonna pay me back in the future, and we are talking about like years later, you have to pay me an extra interest because time has money. Time has value in the money, right? So we'll focus on valuable consideration in this video. Now let's get to an example. We've talked about this TrueTag, which makes gaming platform and subscription. And here we have a new company, which is a gaming company. They have these online games, ProSport, and they wanna put their games into the TriNet network. So this client, ProSport, offers popular games like Brawl or Fans, and wants those games to offer on the TriNet, so ProSport can sell gems, weapons, health potion, and other related to the players to advance more quickly in the game. So I guess everybody is familiar with this type of earnings models. Okay, let's get to the accounting. On January the 1st, 2021, the client ProSport pays TrueTag an upfront fixed fee of $300,000 for 6 months of feature access. So in order to use your network, ProSport is going to give you this $300,000 fixed fee. And ProSport will also pay TrueTag a bonus of $180,000 if in the network the users access the games for at least 15,000 hours during the 6 months period. Now we are TrueTag, and so of course we wanna boost up our revenue amount as soon as possible, right? We really wanna put all the 180 upfront, recognize it as soon as possible, so that we will have a really good earnings, and that's basically what Apple is doing. So they start this estimation. TrueTag estimates a 75% chance that it will achieve the user's target and receive this $180,000 bonus well, which means there's 25% chances that you cannot guarantee the 15,000 hours. Well, although I want to recognize it for sure at once, but I'm not allowed to do it. Why? Because it's uncertain, right? It's not a certain thing. There is still 25% chances that I cannot achieve the target. Okay, so we'll talk about this variable consideration in this situation, which is the 15,000 hours target, and that is a variable that may not be achieved, but we really want to record as much revenue as possible. So when TrueTech has the money, right, upfront, $300,000 upfront, this is what the TrueTech does, and it is, you know, very familiar, not hard. It's a deferred revenue because you pay upfront, and TrueTech hasn't even started 6 months, you know, platform service yet. So I put the $300,000 in cash, and then I have it in my liability account called deferred revenue. Now let's get down to the bonuses. So there are actually 2 alternatives that the TrueTech companies can do with this 180,000 bonuses. Number one is to do a weighted average, and we call it the expected value. In that sense, I do the following. I know that there is 75% chances I can get a total amount of 480, which is the fixed fee of 300 plus the bonus. And in it, I will have an expected amount of 360 because I times the 75%. And there is also the rest 25%, I will have 0 bonus. And in this situation, I will only have $300,000, which is the fixed amount paid upfront. I times the 25%, and then that gives me an expected amount of $75,000. I add these 2 up, and I get a weighted average of $435,000. I can put it in to my revenue for 435. That will be my expected revenue. Sorry. Now, the second alternative is not taking an average. Instead, I go for the most likely amount. In that sense, in this case, I have a 75% and 25%. The most likely is the 75% chances, which is when I get the $180,000 bonus. So I will treat my accounting as if I get the bonus because that is the most likely amount. Well, so if in this case, how do I do it? Well, because there's a greater chance of qualifying the bonus than not qualifying. So then in total, I will have 300 plus 180 equals $480,000. Let's assume that TrueTech bases it estimate on the most likely amount. In each successive month, TrueTech will recognize 1 month revenue based on a total transaction of 480. Because it previously recorded $300,000 as deferred revenue, yeah, it's true. At the end of each month, TrueTech will reduce the deferred revenue by 1/6 of the 300. Well, that's fair, right? 300 is gonna be allocated evenly into 6 months. And this is for the 300. We also have a bonus. So how do we kind of recognize the bonus? We're gonna create another account called bonus receivable. And each month, I'm gonna do 1/6 of the 180 and treat it as my bonus receivable. So the calculation for each month is gonna be deferred revenue. I'm gonna take out 300 divided by 6, which is $50,000. Bonus receivable, 180 total divided by 6, which is $30,000. So I'm gonna recognize revenue, right? Credit service revenue each month, gonna be the total 480 divided by 6, which is 80. Well, that's kind of sums them up, right? 50 plus 30 is gonna be 80. And this is every month what we are gonna do. transferring it to a key account to have a better visualization. We have a deferred revenue at first when we receive cash. So on January the 1st, this is the transaction. We received $300,000 upfront, and I put a debit on cash, which is the left-hand side, and then I put a credit on deferred revenue. That's a liability, so credit means increase on the right-hand side. Now, each month, I know I'm gonna recognize an $80,000. That's the most likely situation. Where does the $80,000 come from? It comes from number one, here. I have to reduce a 50 from my deferred revenue account, but that's not enough. And I have to find a 30, right, the difference, $30,000 somewhere else. I know the company, ProSport, hasn't paid me yet, but I expect them to pay me soon. In that case, isn't it a perfect definition for receivable? I expect the client gonna pay me soon. And that's why I created a T account called bonus receivable. There's nothing on when we receive money, but by the end of each month, I'm gonna increase this bonus T account for $30,000. Now, if you look at it, let me use a different color. On the debit side, I have debit 50, debit 30 equals credit 80. That is gonna be the journal entry. And I'm doing it for every month. By the end, when it is the end of the 6 months, 6/30, June 30th, my deferred revenue account will come down to zero because I've used the total of $300,000 all. And my service revenue summing up to $480. Let's look at the bonus. The bonus revenue account each month by debiting $30,000, we accumulated $180,000. And when we actually achieve the target, we receive the $180,000, we're gonna receive it by cash. And in that sense, I will have to debit my cash and then credit the bonus receivable. So eventually the bonus receivable account will come down to zero. That is when we have cash, we reduce the receivable amount. Now, we describe the situation when we receive the bonus. And finally, we're gonna do the following journal entry, debit cash and credit bonus receivable. So eventually bonus receivable equals to zero. Zero balance is as if it doesn't exist. What if FoodTech, our company, does not receive the bonus? Well, that sucks, right? And I have to reduce my service revenue because I have booked 480 here. And now I'm not entitled to the total 480. I'm only entitled for 300. So the true amount should be 300. How am I gonna do it? Let's go back and take a look. What we are doing is to debit a service revenue for 180 and then credit the bonus receivable account for 180. Well, if you compare these two parts, the credit part is the same. Eventually, I'm gonna reduce my bonus revenue receivable account to 180. It's just the thing that we debit is different. If we achieve the target, I will receive another 180 so that my cash will increase. If we don't receive the bonus, then I have to reduce my service revenue. So let me change the color to red. Now, what we are doing is so instead of doing this, when we do not receive, so we don't have this 180 coming up in my cash. So cash is only 300. But we still have to reduce this bonus receivable account because before we have, the left-hand side, we have a total of 180, and that is not true. We don't have any receivable. So we have to do a counter account, which is literally write something on the right-hand side, credit it. Eventually, it has to come down to 0. Now we have a right-hand side, which is credit. Where should we do the debit? The left-hand side. Then it must have to be the service revenue, because we also need to adjust the service revenue. It was 480 before. I want it to be 300. So I am reducing it by 180. So I debit $180,000 from service revenue. It is on the left side. And meanwhile, this journal entry will also reduce the bonus receivable so that eventually bonus receivable have a 0 amount. This is gonna be when we do not have it. Turn out a lot of companies will try this most likely situation. Well, who doesn't want to have a revenue as high as possible and as soon as possible? Now, this is the case when eventually it finds out that there's no chance it cannot meet the target of 15,000 hours. What if in the middle of 3 months, right, in the end of 3 months, they found out that it's impossible to reach the target for the bonus? What should you do? Well, you should do this part in the middle, but change the number to whatever exists. That, for example, this amount, then you're gonna do credit of $90,000 to the left of service revenue, as well as to the right of bonus receivable. Remember, the purpose is to erase the balance for bonus receivable. There's not gonna be a bonus receivable. And you have to adjust your service revenue down. That's for variable consideration. To do that, you have to create another T account for bonus receivable. In the next video, we're going to talk about another issue to consider in step 3, which is principal or agent. I'll see you in the next video.